So I guess I will start. Good morning, everyone, and welcome to the Teachers Retirement System Investment Meeting. Today is September 13th, 2021, and I will hand it over to Thad to take the roll call.
Good morning, everyone. John Adler.
I am here.
Good morning, John. Thomas Brown.
Good morning, Thad.
Good morning, sir. Natalie Green-Giles.
Good morning, everyone. I'm here.
David Kazansky.
Present.
Russell Buckley.
Good morning, Thad. I am here on behalf of Department of Education Chief Financial Officer Lindsay Oates. A happy first day of school to those of you who celebrate.
Deborah Penny.
I am here.
And Susanna Vickers.
Good morning, I'm here.
Good morning. Madam Chair, we have a quorum.
Okay, thank you, Thad. And I see we have Yafa here. Good morning. Perfect. Okay, so we're going to turn it over to Robin from Rokaton for the Passport Funds Performance Review.
Good morning, everyone. I'm in turn going to ask Mike Fulvio, but first I want to say it's a pleasure to be back with the board. Mike?
Good morning, everyone. Wonderful to see you all. We'll start with the, it's actually in the quarterly report for the Passport Funds, and we're going to take a moment or two just to go through the fiscal year results, which are included in that report as well, which we did not review together over the summer. So if you wouldn't mind flipping ahead to page 24, I'll make a few comments there about what we saw as a reminder in the markets during the 12 months ending June 30, 2020. And you'll recall that that captures much of the market recovery that we saw over the last 12 to 18 months as the world became more adjusted to dealing with an ongoing global pandemic. And with the market recovery that we saw during that 12-month time period ending June 30th, you can see really strong absolute returns across markets, which naturally served the participants invested in the Passport Funds quite well from an absolute return perspective. The Diversified Equity Fund, which ended the fiscal year of $19.7 billion, returned 43% for that 12-month time period. When compared to the broad US market, the Russell 3000 index, you can see that market was up about 44%. And the hybrid benchmark, which represents the underlying asset allocation of the fund, and it also includes non-US equities, you can see the hybrid benchmark was up about 41.7%. So the relative outperformance between the Diversified Equity Fund and the hybrid benchmark was driven largely in part to the contribution of active management among both the underlying US actively managed strategies as well as the non-US actively managed strategies. So not only strong performance in absolute terms, but also on a relative basis during that 12-month time period. You can see the active US composite outperformed the Russell 3000 by approximately 14%. And then in the international composite, strong outperformance there, you can see a 38% return versus about 35-36% for the international composite benchmark. So again, it was a strong period for the US, up 44%, non-US developed markets up about 32%, and emerging markets up about 41%. I'll pause there and see if there's any questions on the Diversified Equity Fund. Otherwise, I'll comment on the other funds before spending a moment on the active manager scorecard. Hey, John.
Yeah. So didn't we decide to start doing an 80-20 or something like that benchmark?
We did, yes. And so that'll begin effective July 1st, 2021. And so you'll see that on the next report.
I see. Do you have any sense of how the diversified fund did versus 80-20 for the past fiscal year, or that would no? The answer is no.
On a rough basis, it would have outperformed because of the strength in the U.S. Markets and the value add that we saw both across the U.S. composite and the international composite. So we would have expected some value add there as well relative to that benchmark.
Perfect. Thank you.
So beyond the diversified equity fund, you can see the balanced fund had assets of 581 million at the end of the fiscal year, with a fiscal year return of about 12.1%. The international equity fund returned about 37.5% ahead of its composite benchmark. The sustainable equity fund returned 39.6%, which you can see here lagged its benchmark by about 3%. And then below that, the US equity index and international equity index funds in their first full fiscal year, you can see those returns of 47% and 36.5% respectively. I'm not hearing or seeing any questions. I'm going to ask everyone to flip ahead to page 38. And that begins the active manager scorecard. And that's also covered off on the following page. There's no new flags to note here to the board. These flags are similar to those that we reviewed last quarter. And any necessary manager reviews will be held in, in the coming month or so when we engage with managers to discuss performance and any updates they have. So I'll pause there. Go ahead, Robin.
Maybe I could just add a point, just to remind folks, Mike and I are so used to looking at this scorecard, but that it's obvious to us. But just to make sure everyone knows, what we've done here is this in the first four sets of numbers, columns of 1 year through expected mean net. These are excess returns. So we take the actual return of the manager after fees, after their benchmark return. So what you see here is either outperformance of the manager specific benchmark or underperformance. And then we have the fourth column, expected mean, means expected excess return over time. And where there are green highlights, either light green or dark green, that means that the manager has outperformed significantly relative to their benchmark, and relative to our expectations. And the red or pink highlights are where they've underperformed. So what we're trying to do is just say, how has this manager done relative to their benchmark and relative to our expectations of their excess return? And then we put it in 1 or 2 standard deviations away from the expectation. So all we're trying to do is take the return numbers and put them in some sort of actionable framework, because we know managers will outperform, will underperform under various periods of time, and a lot of it's noise. And we're trying to highlight where there's significant deviations from expectations. And so there's only one manager that has significantly underperformed. We've talked about this. And the other managers are either within expectations or above expectations. And we also pay attention to the above expectations, because what you want to make sure is that the manager hasn't changed their style, is not altering their risk management process. So that's what this scorecard is intended to do. Any questions or comments on this?
Looks good. Thank you. Very helpful.
Great.
So you guys, I guess you guys will be engaging with Cardinal.
Yes.
Respectively.
Yep, well, we can address it in executive agenda
Oh, thank you.
as well.
That's right, yes.
Russell, did you have a question?
Yeah, I just wanted to quickly ask about the tracking error. I noticed some conditional formatting, obviously, on the excess return. I was curious. I see on slide 40 that the tracking error has some light blue, dark blue. Is the conditional formatting not there because they're all within expectations?
Yes, that's exactly it.
Okay.
Mhm.
Okay, thanks. Just wanted to confirm. And then there's no conditional formatting applied to the consistency column?
There's not.
Got it. Thank you.
Okay. Maybe we can move on to July, Mike?
Great. So if everyone has that report handy, I'll just make a couple quick comments, not only for July, but really what we've seen in markets through the summer. And I guess the key takeaway is we've continued to see positive results for equity markets in the US and abroad as a whole over that time period, particularly in US and developed markets. Emerging markets for the month of July did lag by about 6.7%, or I should say return negative 6.7%. But we are seeing more volatility in the markets. So that, there's a lot of driving factors there, increased focus or discussion around the growing number of cases in the US related to the Delta variant, increased concerns for inflation. Is that inflation here to stay, or is it more transitory? How much of that is related to just the sheer opening up of our economy and supply deficits as it relates to labor shortages and other materials. And so we've seen through so far the beginning of this year, the cost of materials have certainly increased as well. And then also as we look at, in ongoing discussions at the Federal Reserve, an increased likelihood that in late 2021, they may begin tapering the monetary stimulus in the works. So a lot of discussion in the markets. And as you can see here, all told, July was a positive month for the US and developed equity markets abroad. It also did mean positive returns for the diversified equity fund as a whole. And so you can see at the end of July, the return for the month was about 1%. John, you did point out the global market composite index, which again, incepted on July 1st. We did backfill the performance of that with the Russell 3000 index, which, as you'll note, was one of the two benchmarks for the diversified equity fund historically. And so 1.1% return for that market proxy. The hybrid benchmark, which continues to represent the underlying benchmarks for each of the strategies within this fund at their target weight, returned about 80 basis points. So some modest outperformance by both the US and non-US equity composites during the month. And so far, a good start from a fiscal year perspective. And you can see calendar year to date, the fund has returned about 14.8% versus the hybrid benchmark at about 14.2%. And again, that global market composite benchmark, as shown here, this first 6 months of that calendar year to date time period represents the Russell 3000. So that's why you would not expect to see, John, to your question earlier, the value add if it was the 80-20 in that prior time period.
The prior time periods are the previous benchmark, and then prospective from July 1st will be the new global benchmark.
That's correct. Beyond the diversified equity fund, you could see the balanced fund for the month had a return of about 42 basis points. The international equity fund ahead of its benchmark returned negative 0.68%. The sustainable equity fund with a strong month for value add on a relative basis, outperforming by about 3.3%, had a 6.3% return. And the US equity index fund and international equity index funds returned 1.7 and negative 1.2% respectively. So if there's no further questions there, I'll spend just one moment on the preliminary monthly returns through August, which are on the benchmark report. And again, it was another positive month across the board, with the global market composite for the diversified equity fund up about 2.7%. For the month, the diversified equity fund's hybrid benchmark was up about 2.5%. We should expect to see these track relatively closely looking forward, and maybe even more closely over time. The underlying benchmark returns there, you can see the Russell 3000 index with a return of about 2.8%. So another strong month for August. The diversified strategies composite up about 2%. And then the active US equity composite returning about 2.3%. Active US equity composite benchmark, my apologies. You'll recall that also beginning July 1st, that benchmark reflects the underlying manager targets, their benchmarks held at target. And that follows the same approach as we discussed with the international composite benchmark, which returned about 2%. The balanced funds benchmark returned 70 basis points during the month. And then beyond that, you can see the underlying components of the international fund and composite benchmark. Developed ex-US markets up about 1.8%, non-US small caps up over 2%, and emerging markets with a strong month of about 2.6%. The underlying strategy for the sustainable equity fund was up over 4%, also ahead of its benchmark. And then the index funds were each up 2.9 and 1.8% for the US and non-US funds. Okay, well, if there's no other questions on the reporting, we'll pass it back to Madam Chair for the next topic.
Okay, great. So next up, I guess we're going to turn it back to you. We have the educational overview of the CLO Equity.
Wes, did you want to introduce this topic?
Yeah, please. Good morning, everybody.
Thank you, Wes.
Hi, everyone. It's Wesley Pulisic here on behalf of Controller Stringer. I'd just like to thank you for the opportunity to discuss this topic with you. CLO equity is one of the manager or strategies within the opportunistic fixed income opportunity set. Ina Suo, who is just turned her camera on, has been the lead on this within the alternative credit group. So I'd just like to hand it over to her. And I think she has some slides that she'd like to walk through if that's possible for her to share.
Good morning, everyone. My name is Tina Suo. I'm a senior investment officer in the alternative credit team. I'm here to give an introduction of collateralized loan obligations. It's not a new product. In fact, it has been around for many years from the late 1980s, but it has grown tremendously, especially in recent years, due to the wide support from institutional investors. Given this renewed attention and interest, we believe it is the right time to give an overview of this product and address some of the questions you might have, which we hope would help to demystify this product. The presentation is broken down. Can we go back to the summary page? Yeah. The presentation is broken down into 3 sections. First of all, the definition. What exactly is a CLO? Second, an overview of the current market. And finally, what does it mean when we say we invest in CLO? Next page. A CLO essentially is a securitization backed by a diversified pool of loans and financed by debt and equity. So what exactly does it mean? Basically, what that means is a CLO is very similar to a financing company that borrows money from debt investors, raise equity from the equity investors, and invest in a diversified pool of loans, but for a finite period. So if the finance company doesn't really have a legal maturity, a CLO does. So the chart here shows the asset and liability side of the CLO and a typical capital structure. On the left-hand side, the asset side is a pool of 150 to 300 senior secured, broadly syndicated loans, the same type of loans held by your system. On the right-hand side, the liability portions, there's debt and equity. Here, you will see the typical capital structure. There are different tranches of debt from AAA to BB. These letters signify their seniority, meaning which ones get paid first. As the name suggests, AAA tranches has the highest priority in terms of payment. The loans on the asset side generate interest income, and these will go to pay the coupons on the debt tranches first, based on the order of seniority. Only after the debt holders receive their coupon payment, the equity holder will receive what's left. This is commonly referred as cash flow waterfall. Any question here? If there's not, I'll move to the current market. Next page. So now let's look at how this market has evolved. While CLOs have been in existence since the 1990s, the issuance wasn't really meaningful until early 2000s and really increased in the years leading up to the financial crisis. This was due to the appetite at the time for all types of securitization products, namely CDOs. Keep in mind that during this time, the majority of CDOs were backed by tranches of subprime mortgage-backed securities. CLOs were really a small portion of the CDOs issued during this period. As you can see on the right-hand side chart, total outstanding CLOs peaked just under 300 billion pre-crisis. What's not shown here is that total outstanding subprime-backed CDOs was more than 1 trillion. Post-crisis, subprime-backed CDOs have disappeared because of the very poor performance during the crisis. CLOs, in contrast, performed very well through the crisis, and investors came back to this asset class. As a result, the market grew significantly post-crisis, with strong issuance every year since 2012. Even in 2020, CLO issuance only paused in March and April, and by May, it had come back. This year, global issuance continued to be strong, reflecting very robust investor demand for the product. Next page. CLOs issued prior to Great Financial Crisis are usually referred as CLO 1.0 to distinguish from CLOs issued today, the 2.0s. The reason for the distinction is because there are some key structural differences between the 1.0 and the 2.0. There are lessons learned during the crisis from the subprime-related CDOs that prompt those changes. The table you see here summarizes the key differences. One, the portfolio is much more conservative. There are more restrictions. For example, there is a minimum first lien, which is higher in the 2.0. Triple and below rated assets are lower, subject to a limit of 7.5% versus 10 to 15% pre-crisis. There is a much smaller bucket for high yield bonds, and there is no tranches of other structured products that can be included, essentially eliminating leverage on leverage. Two, there is better protection of senior debt. Senior debt nowadays is a smaller portion of the entire capital stack, meaning it's less levered. So the portfolio can withstand higher loss before senior tranches is impaired. Three, there's better asset liability matching. The financing of CLOs is locked at issuance, and there's no mark-to-market triggers that would cause forced selling. So CLO managers are incentivized to hold assets over the long term rather than liquidating at the lows. Next page. Investors in CLOs have a wide range. Typically, higher rated tranches are owned by insurance companies and banks because of their yield pickup compared to other investment grade debt. Equity tranches are sometimes retained by the managers themselves or by the investors that are attracted by the higher income and higher total return potential. Those are also tend to be the investors that can withstand intermittent volatilities and have longer time horizons. Here on the table, laid out the investor types for each part of the capital structure. As you can see, pension funds, insurance companies, these are the type of the long-term holders that they invest across the capital structure. Next page. Investing CLO debt. Now let's look at where CLO debt pays and compare them with similarly rated corporate debt. The chart on the left-hand side compares the yields of a corporate bond versus a CLO tranche that had the same rating. The green bars are the differences. As you can see, at each rating, the CLO tranche yields more than the corporate bond. This is due to the greater complexity of CLO debt and, of course, lower liquidity. Now let's look at the riskiness of CLO debt. We compare the default rate and the loss rate of CLO debt versus corporate bond and subprime related CDOs. First of all, CLOs perform much better than the CDOs. Secondly, if you compare those to bonds, CLOs also have lower default rate and in turn loss rate. In fact, there was no AAA or AA rated CLO debt that ever taken a loss, including those issued prior to financial crisis. This is very remarkable. Next page. So now let's look at the historical returns of CLO debt and equity. The table here shows the annual returns of the past few years and compare that with high yield and ID bonds. First of all, as you can see, CLO debt and equity tend to have extremely strong rebounds after a period of distress. And this benefits investors that have longer investment horizons. The feature also makes them a very good fit for trigger-based contingent capital. Secondly, on the right-hand side chart, this shows that CLO debt have favorable risk-reward characteristics compared to other spread products. For example, the BB rated CLO tranche have similar volatility as high yield bonds, but higher returns for the past 5 years. Next slide. Now let's look at the characteristic of CLO equity and the historical returns. As a reminder, CLO equities is about 9 to 10% of the capital stack and receive the residual income from the assets after debt servicing is paid on a quarterly basis. This is what we call the cash flow returns. There's no J curve here. Equity returns get paid from the very first quarter after the issuance. Historically, the cash flows generated by equities average about 18% year on year. What's notable is that even in 2020, cash flows to CLO equities was 11%. Another year of double-digit return. At the end of the CLO's life cycle, CLO equity also gets a final payment after all debt have been paid off. So there is a realized IRR for CLO equities if the CLOs have been liquidated. The available statistics is until 2014 vintage. And as you can see on the right-hand chart, median realized IRRs have been 13% during this period. However, there are significant vintage and manager dispersions, which speaks to the importance of having vintage diversification and partnering with the right managers. Since both the cash flow returns and the residual value are very sensitive to portfolio losses, CLO managers need to actively manage a portfolio and achieve a balance between risk and spread. Next page. Now let's look at the assets that's backing the CLOs, basically bank loans. Post-crisis, bank loans have become a large and institutional asset class, exceeding 1.5 trillion globally. Today, many issuers are large companies with substantial equity backing. As a result, default in loans have been stable and trending down. Currently, the last 12 months default in loans is less than 1%, much lower than the long-term average. Year to date, only 4 issuers defaulted. Therefore, there have also been more upgrades in loans than downgrades. During 2020, what we saw is when loan price was also impacted, the equity holders were very willing to contribute in equity, therefore preventing default and losses of the loans. Finally, as mentioned earlier, CLO portfolios have certain criteria that limit the type of loans it can hold. As a result, loans held by CLOs tend to be higher quality than the broader loan market. The graph here shows the percentage of triple C rated assets and default rate in CLOs and compare that to the broader loan market. As you can see, triple C rated loans and default rates are both lower in CLOs than the broader loan market, speaking to the quality of the loans held in CLO portfolios. Study also shows that CLO managers were able to add value by selling at-risk credits early. This has resulted in lower portfolio loss of CLOs compared to the broader loan market, which is again favorable for CLO debt and equity investors. This concludes our presentation on CLOs. We're available for questions both now and after the meeting. Thank you.
Okay, now I'm muted. Thank you so much, Tina. Does anyone have any questions for Tina or Wes?
So just to jump in here, if I might, so I think this was very helpful and a great presentation of what is sometimes a complex strategy. We have I can tell you that Rokutan clients, many of Rokutan clients are investing across the capital stack of CLOs. And the reason we thought that this made sense as an agenda item for today's meeting is that we may be bringing some investment ideas forward for the opportunistic fixed income portion of the pension plan. And we thought it might be easier to talk in general about this asset class and then at a later date talk about a specific investment opportunity.
Thank you, Robin. And still no questions? Okay, all right, hearing none.
I wouldn't mind asking a couple of quick questions. Mine may be very simple. I'm just trying to make sure I'm following the whole of the presentation. So Robin, you actually mentioned investing across the capital stack. That's to imply that we would, invest in either senior, mezzanine, or equity tranches in theory. That's what investing across the capital stack means?
Yes.
Okay.
That means you can choose depending on your risk return objective, you choose what level of the balance sheet essentially you want to invest in.
Gotcha. And I don't want to get too in depth on that piece other than just, would there be situations with the same manager we would be investing in all three tranches? Or is it kind of pick and choose as you go?
Well, it's typically you pick a strategy that's focusing on a specific part of the investment structure because you've really identified your risk tolerance and your return needs. And so you don't typically mix equity and above investment grade. That would be very unusual.
Got it. Is that essentially, or we like investing with managers who are picking the strategy and they're picking up various CLOs within that specific strategy, and they would typically be focused on specific tranches?
Yeah. Typically, you're saying this is what we want to get out of this investment, and therefore we're looking for a manager who's experienced investing in this part of the CLO market.
Got it. Thank you. And I guess I wanted to be switching gears slightly. One more question. Just want to make sure I was capturing all of the acronyms because we were talking about CLO 1.0, CLO 2.0, and that's helpful. There was another acronym thrown in there that I want to make sure I caught. It's an MBS, mortgage-backed securities. Is that sort of the equivalent for CLO 1.0, or am I picking up on something different there? Or am I missing it?
Tina, do you want to respond?
Sure. Mortgage-backed security is different. Mortgage-backed securities are backed usually by residential or commercial mortgages, and it's there's agency and non-agency. So those are not CDOs or CLOs. CDOs are really collateral. Okay. CDO is collateralized debt obligations. So what happened was there were, during crisis, prior to crisis, there were a lot of non-agency or what we call private label, which is really a nice term for subprime backed mortgage securities that are being issued, right? So the the lower rated tranches of those cannot be sold. So then they were packaged into CDOs, and they were handled by the CDO desks and sold as CDO products. So those are called subprime related CDOs. So you know, and first of all, there's just a ton of subprime backed RMBS, and then there's subprime tranches backed CDOs. So combined, that's why, you know, the total exposure and the size of the crisis was just really massive, because you kind of combine the two, right?
Okay.
But
okay.
really,
So
we're talking about
let me
CD.
try to-
Sorry, I digress. So, you know, we really were focusing on CLOs was lumped into CDOs prior to crisis, right? But CDOs really depending on what the collateral that's backing the CDO, the structure, right? So if you look at the CDOs used to be only backed by loans and bonds. And later on, prior to crisis, people introduced CDOs that are backed by subprime mortgage-backed securities, or tranches, lower-rated tranches of the subprime RMBS, right? So those CDOs were the ones that had problem and severe losses, because
And those
essentially
CDOs are not, they're not CLOs, is what you're saying.
no, they're not.
They're
CLOs
a subset of CLOs.
No, okay. So CLOs is
Not
a
even,
subset
not even.
of
Okay.
CDOs. No, yeah, CLOs is a
Okay.
subset of CDOs. CDOs, it just means collateralized debt obligations, right? The debt can be all kinds of debt. It used to be that it's only high yield bonds and loans, right? And later on, prior to crisis, the debt backing the CDOs became tranches of subprime IMBS. So if you, and you know, the debt can also be other products, you know, consumer loans, auto credit, and student loans, things like that. So it's really those. So when you look at CDOs, you have to separate into the collateral type. The type of CDOs that are backed by subprime related products were the ones that defaulted and had severe losses, and they never come back. There's none, basically. Subprime, you know, non-QM products still exist, but there's no CDOs backed by those products anymore.
Thank you, Tina. I appreciate the lengthy discussion. I wanted to make sure I got my acronym soup correct there and understood what we were talking about. So I'll take a step back if there are any other questions.
Okay, hearing none.
Yeah, I am sorry. I have a quick question. I'm still trying to process. It's Natalie. And this sounds incredibly naive probably, but everything you're describing sounds relatively lower risk, higher quality. And I'm wondering, why is this considered part of the alternative space? Because it sounds not in that typical profile.
I wouldn't. I think, first of all, you know, CLOs, it is a securitization product, right? There's great complexity of the product. You have to, in order to buy it or assess it, right? You know, you have to, typically people have looked through of the underlying loans. And here the underlying loans is between 150 to 200 across, you know, basically all industries, right? So in order for an investor to kind of purchase it, you know, they need to, there's great analytical ability to, or analytical platform that's typically required. Secondly, you know, it has you know, lower liquidity. A lot of these tranches don't trade. They don't, you know, they're bought and held by banks, insurance companies, and pension funds, right? So typically there's an issue of sourcing those assets. You know, and from, you know, they're not really held by mutual funds. In fact, I would say any product that have daily liquidity needs, is not a good fit for holding these products simply because you can, first of all, it's hard to buy. Secondly, it's if there's daily liquidity needs, when you're forced to sell, there may not be a market. So mutual funds typically are not the natural buyer of these products. And managers that have expertise in these products are, there's a limited number of counterparties that regularly trades, and they get color from who might be a seller. So it's essentially a very, I wouldn't say completely private, but a lot of bilateral transactions.
Yeah. And Natalie, just to add to that, and that, by the way, that's a great question, because that the higher tranche stuff, the AAA tranches within the CLO, those could those are investment grade, right? I mean, those don't meet the return targets for your opportunistic credit program. So that's why we look at the lower, not the lower rated stuff that has a higher return target, a good risk profile, better risk profile relative to other things in the market. And that's where that would be more appropriate for your return targets. So you're right. The AAA stuff is purchased by insurance companies. And I mean, we haven't had the discussion, but there could be a place for that exposure within teachers, but that doesn't meet the return target for OFI. So we look at the lower rated stuff too for that return profile.
Thank you. That is extremely helpful.
No, but you picked up on it, so I appreciate that. Thank you.
Okay, any other questions? All right, so Tina and Wes, thank you again. And now it's time for executive. Yeah, thank you. Do I hear a motion to go into executive session?
So
Thank you, Mr. Brown. Do I hear a second?
second.
Thank you, Susanna. Any questions? All those in favor, please say aye.
Aye.
Any opposed? Any abstentions? Okay, going into executive session. I'm sorry, we're back into public session. Ms. Stang, would you read out, please?
Certainly. In executive session, we received an update on the implementation of an investment initiative within the pension fund. We received a presentation on the allocation of a composite within variable A. Consensus is reached, which will be announced at the appropriate time. We received a presentation on the implementation of a policy within the pension and variable funds. Consensus as to a path forward was reached.
Thank you very much. Okay, anything else you would like to add? Okay, hearing none. Do I have a motion to adjourn?
So moved.
Thank you, Mr. Brown. Do I hear a second?
Second.
Second.
Oh, thank you, Susanna and Russell, both same time. All those in favor, please say aye.
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 Any opposed? Any abstentions? Okay, we stand adjourned. See
Thank you, everyone.
on Friday at the Sim.
Thank you.
Have a
you.
good day, everyone.
Have a good one.